Hello, welcome back to my YouTube channel. This is Aishwarya. We are doing accountancy of class 11 under CBSE syllabus. This is chapter 2, part 1. So in this video, we will be covering the following topics. Okay. Now first let's see what is GAAP. Generally accepted accounting principles, right? Okay. So from the beginning we've seen that all the transactions has to be recorded, right? But how will you record? So it's GAAP that tells you how to record the transactions, okay? The way, the principles, the rules that has to be followed in order to record a transaction. So it is nothing but rules and guidelines, okay? And how are these guidelines formed? They've been formed over a period. It's not like that one day someone sits down and writes the rules. No. Through various customs and past experiences, various suggestions taken from professionals, government regulations, and then it will be formed. And is the rules very rigid? No. They can be amended from time to time based on the legal, social, and economic environment. Okay, if you want you can still change the rules as and when the time demands. So this is what it is kept. So all the rules, they have put together the rules, the practices and the assumptions, based on which the accounting theories and reports are prepared. So all this they have combined within these 13 basic accounting concepts. Okay, so based on this the accounting reports will be prepared. Okay, now let's see this one by one in detail. So first, business entity concept. Okay, so business is a separate entity from its owners. So that's the bottom line of this concept. So owner, like how he has a separate identity, address, a separate bank account, the same way the business will have a separate name, separate bank account, separate identity, meaning the nature of the business. And okay, its assets and liabilities will be separate from that of the owner. Owner's assets and liabilities will be his personal and which will not be included in the books of accounts. Okay, and whatever the owner invested in the business, it will be shown as a capital in the business. Okay, in case he's trying to take money from the business, it will be shown as owner's drawings. Okay, it is not like he is taking from his own pocket. So this concept deals with the separation of ownership, so that any liabilities comes, it will be only the liability of the business and not the owner. Okay, even if the owner is not there, the business will go on. So next concept is money measurement concept. So all the transactions has to be expressed in terms of money. Okay, so something that cannot be measured in terms of money cannot be recorded in the books of accounts. We've seen this earlier also, like appointment of manager, employee morale, your employee training, research happening in your company, all that you cannot express. So everything has to be converted to the monetary value. Supposing I'm accounting for the assets, okay, I cannot write I have 50 laptops in my company and write laptops 50 numbers. No, you have to write the value of such laptops. See, like factory you cannot mention as 2 acres, you have to mention in the value like 2 crores. 30 computers you can't mention, you have to mention the value like 50 crores. Raw materials 20 tons, you can't mention, the value has to be mentioned so that you will get a total figure of all the assets. Okay, but one of the limitations here is the purchasing power of money is not taken into consideration. So as time goes, the purchasing power of money will decrease, right? So whatever 100 rupees will fetch me today is way different from what 100 rupees would have fetched me like 10 years back. So that's called the purchasing power of money. So, and adding assets bought in different times. So we would have bought assets like 10 years back, and since the assets are recorded in the historical cost, only that cost will be carried forward. So the current value will not be taken into account considering the appreciation or depreciation of the asset. Then next is going concern concept. So this concept assumes that the firm will continue to carry out its operation indefinitely, okay, for a certain considerable period of time. Nobody starts a business just to end it within a year or a two. So we start a business so that it goes for so many years. So how this concept helps in accounting? So supposing we buy an asset, okay, here let's see the example that's given in your textbook. A computer is purchased for 50,000, okay. So this computer has a life of 5 years, okay. So the first year only we don't charge this entire 50,000. So since we assume that the business will go on for more than 5 years, so we will take only the 1/5 portion of the total expenses that has been spent on the assets, because since it has a life of 5 years, so first year I am just using it proportionately. Only this will be taken for the first year, and next year and going on till the 5 year. So without this concept, you will charge the entire 50,000 in the 5 year, in the first year, and that will drastically reduce your profit in case you are making heavy capital investments. So that's why the concept of depreciation has come in, where you spread the investment across. Okay, so next we'll see accounting period concept. So how do we prepare an account? So we prepare for a specific period. Mostly the period will be 1 year. Okay, so the 1 year we will see the result, if the company is making profit or loss, if the company is having enough asset to meet all its liabilities, the financial health of the company, everything will be done for a particular period. Usually it is a year. And if your company is listed in the stock exchange, okay, when we list companies in the stock exchange, if you want the general public to buy your shares, invest in your company, then the company will get registered in the stock exchange. It has to follow the guidelines given by SEBI, get the company registered. In such cases, such company must publish their results every 3 months for their investors to keep a check on the performance of the company. Okay, so in case of a partnership company where there is a retirement of a partner or an admission of a partner, in that case interim statements will be prepared, okay, to find out what is the result of the company till then, and if you are sending him, you can send him with his profits. Okay, for in India the accounting period is usually from April to March, okay, but other countries like China, Russia, France, I guess, so all these they have the calendar year Jan to December as their accounting period. Okay, next comes cost concept. So how do you record a transaction? Supposing you are buying an asset, you record it at the cost at which you have bought. So that cost will include acquisition cost, transport cost, installation, preparation, everything. Okay, supposing I am buying a plant or a machinery. So I buy the plant, I transport it to my premises, and then if there is any repairs I make, or if there is installation cost, that also I spend. The total cost I will be recording it as the cost of the plant, so in order to put it into use. Okay, so that these documents can be verified in the future also. One of the limitation here is this do not show the true worth of the asset. Okay, uh, so few assets may appreciate, few may depreciate, but we will continue to go with the historical cost concept, because the market value is unpredictable. You can't predict a precise market value for the asset, so hence the historical cost has been carried forward. The next concept is dual aspect concept. So you heard about this accounting equation. Okay, the assets of the company should be sufficient to meet its liabilities plus capital. Why capital? Capital is also a liability of the company towards its owners. Okay, so every transaction will have a twofold effect. So that is why it is called dual aspect concept. Okay, so which means a transaction, if it has a debit, it will have a corresponding credit entry. We will definitely see that in detail in the next chapter. Now I'll give you few examples where you can understand. Okay, so first example, Ram invests 50 lakh in his business. So what will happen? He will debit cash. So there will be increase in the cash business, right? Which is an asset. Asset will have a debit balance. So asset, there will be an increase in his asset. Okay. And then that investment is nothing but a capital for the company. So capital is a liability. So there will be an increase in the liability as well. So can you see both the side there is an increase, the equation is balanced. And the next example is buy goods for 10 lakh cash. So there is a cash purchase of goods. So what happens here? Uh, we have spent, what goes out? Cash goes out. Okay. So the asset portion decreases, and what comes in? Stock comes in. That is also a current asset. So that will increase, decrease. It's balanced again. Okay. Then third example is buy machine 30 lakh on credit basis. Okay, so here this was a cash purchase, this is a credit purchase of an asset. So machinery comes in, which is an asset, so there will be an increase in asset. And then it's a credit purchase, we have not paid, so that person will be a creditor. There's an increase in the liability. So both the side same amount increase or balance is maintained. So this is how the dual aspect concept works. Next is revenue recognition or realization concept. So what is a revenue? So revenue is whatever the business earns. So when it sells its products or services, what money comes in is called the revenue. And other revenues like interest, commission, royalty, dividends, all these are revenues of the business. So when do you record this revenue? You record it whenever it is realized. So when a company has legal right to receive it. Okay, for example, when there is a credit sales, you record the sales on the date of sale and not when the cash is received. So I might give 2 months credit to my customer, but I will record it in the books of accounts on the day the sale is made. And if there are other incomes like rent and interest, so whenever the period it is recognized, I will record it in my books of accounts. So let's see some examples. So rent for March 2017 is received in April, so 1 month later. But when will you record it? You will record it for the financial year 2017, because March is the last month of the financial year, right? So it will pertain to the previous financial year. Okay. And interest for April 2017 is received in March. So it is received in advance. Though it is received in advance, you will not account it for March 2017. It will go for April 2017. Recorded financial year is 17-18. Okay. And when there are some long-term contracts, so these are companies like construction companies. Okay. So where their one project will go more than a year. So supposing in the first financial year, if they have completed 30% of the project, so which means they have spent 30% towards a project, so they can take 30% of the final revenue that they would be earning from the project and account it accordingly. That's why proportionate revenue should be recognized. Okay, same happens in the case of hire purchase and leasing and all that. So as and when the revenue is recognized, it is earned. Then the next concept is matching concept. What is matching concept? So we all prepare accounting reports for a particular period. So we have to match the revenues earned during the period along with the expenses. Okay. So then only you will get a proper result of your operations. Okay. So revenue recognized when the sale is complete, but when not cash is received. Okay. Expenses is recognized when asset or service is used. So we recognize the first example we saw the computer, right? So the 10,000 we've taken only for the first year because I have used only 1/5 of the asset. Only so much I have taken. I did not take the entire 50,000 that I have spent towards the laptop or computer. And say salaries, rent and insurance and all recognize on periods basis. So whenever, so supposing I take a insurance starting from June 2016, but I have paid this month. So I will, but it will be accounted only from June and the expenses will not be recorded this month. Okay. So whenever it is recognized, that is when you have to account for it. Okay. Again, cost of unsold goods. Supposing you are valuing your closing stock. Okay. So I have bought 100 tons of uh, raw material that year, okay, and which is capable of producing, and I have produced 100 units, okay, of which I have sold 80 units, and 20 units is my closing stock, okay. So if I had to value this, I will take, okay, uh, if I had to value the sales of this 80 units, I will take only the raw materials used to produce this 80 units, okay. I will not take the entire raw material cost that I have spent, right. So the revenue earned for that particular period, the expenses incurred, that will give you the profit of that period. So you have to match what are all the related expenses uh, that along with the revenue, and then calculate the profit. I hope it is clear. Then full disclosure concept. So it's very important for the accountant to disclose all the relevant information and keep it transparent. Why? Because in big corporates you have the management and the owner uh, separation, right? So the owners are totally different, the management is different. Who is running the business? The management. And who are they liable to? They are liable to the owners who have actually invested the money, right? So all the material and relevant facts, financial performance must be fully completely disclosed in the financial statements, okay, and accompanying footnotes should also be given to make informed decisions, okay. So um so the basic intention of financial statements is to communicate the financial information of the company. So there is separation of owners and management, right? So that's why it is very important to mention all the relevant details. And the Companies Act, sorry, it is not 1956, it is 2013. Okay, it also prescribes how the mandatory format, the P&L, profit and loss account, and balance sheet that has to be prepared so that everything is covered. And SEBI, Security Exchange Board of India, they are also kind of making it mandatory to disclose all the true and fair view of the business so that the investors are not deceived, okay. So what all has to be covered? So accounting policies, change in, if there is any change in method, the way uh, it is calculated, that has to be mentioned. If there is any contingent liabilities, if there are any related party transactions, okay, if there is any segment informations, any notes to accounts, all that has to be mentioned according to the full disclosure concept. Then consistency principle. So accounting policies and practice must be uniform and consistent over the time. Why? So that will ensure comparisons. What sort of comparison? Inter-period comparison. You can compare your current year statement with the previous year statement, or 10 years back statement. And inter-firm comparison. You can compare your financial results with another company, your rivals or your competitors who are following same accounting methods and uh, preparing their accounts, okay. In that case, comparison will come very easy. So same accounting methods must be applied from period to period. And then inconsistent methods make profits bigger incomparable across years. So if you keep using different methods, then your profit will not be comparable. You cannot compare your profits because there is no point, right? Last year I have used some other method to calculate a profit. This year I have used some other method, and comparing will not give me a effective result. So if you see in this example, usually there are methods in which depreciation is calculated. Depreciation is reducing the value of asset. So first year if I am using straight line method, and next year if I am using return on value method, the amount will differ, and then I cannot compare. So having consistency is very important. But it enables both comparisons, and it is not that it should be very rigid. In case you are changing, you can definitely mention that and you can change the method. Okay, it's not that you cannot change. Changes are permitted. Then conservatism, prudence concept. Okay. So a continuous approach should be adopted so that the profits are not overstated. Okay, anticipate all possible losses. So this concept says that profits should not profits ascertained should not be more than the actual. Okay, so whatever you calculate, the profits should not be actual. If that happens, the company will have to distribute the profits to the owner, and hence the capital will reduce. Okay, so the profits should not be recorded until it is realized. So that's the main point of this concept. And then all possible losses should be provided. Okay, so closing stock should be valued at cost or market value, whichever is lower. And then you have to create provisions for doubtful debts, discounts, debtors, because this may or may not happen, but you allocate some money towards such losses. Okay, and then you have to write off all the intangible assets like goodwill, patents. Over the years you have to write off. So all this will give you a true and fair status of the company. And so stock is purchased at 1 lakh. So if the market value falls to 80,000, this loss you will have to definitely recognize. In case the value increases, this gain will not be recognized until that stock is sold. If it is sold, you can record, but if it's there in your premises, until then this is not to be recognized, whereas the loss you have to account. Okay, next is materiality concept. So accounting should focus only on the material facts. Yes, we've been seeing that from the beginning. Okay, so effort should not be wasted in recording unnecessary facts. So material fact that would influence the decision of the informed user. Then changes in depreciation method and upcoming liabilities must be disclosed. And very small amounts like stationery, eraser, pencils, you need not like sit and mention that separately. Stationery so and so, eraser so and so amount. No, not required. You can just write it as a revenue expenses. Okay, we'll see what revenue expenses are. Nothing but expenses where you use the benefit is used within a year. So you can just write like that and leave it off. And adherence to principle not required for immaterial items, that also not required to be recorded. So material is examples here is adding theatre capacity, so it affects the future earnings, that you have to mention. And then changes in depreciation method, yes, you have to mention. Any future liabilities that you may receive, that also you have to mention. Like I said, simple expenses you can just directly write it as miscellaneous expenses and leave. Then objectivity concept. Accounting transaction should be recorded in an objective manner. How should it be? It should be free from bias. With each transaction should have verifiable documents. Yes. So each transaction must be supported by verifiable documents so that we can avoid fraud. Okay. So cash purchase, there should be cash receipt. If there is a credit purchase, there should be invoice. And historical cost concept should be adopted. Okay, so that the cost is verifiable. Okay, and then market value is not reliable, right? Why? Because the price I am ready to pay will be way different from what you are ready to pay for the product or service. So you cannot rely on the market value, but cost you can anytime pick it up. So the evidence of the transactions are very important for recording them. So this is what objectivity concept speaks about. So let's have a quick glance of all the 13 concepts, a quick revision. So first is business entity. It says business is not equal to its owner. So there is separation. Then money measurement, record only monetary transactions. Okay, only monetary transaction. Then going concern, the business continues indefinitely. So it talks about continuity. And then accounting period, Financial results only for a definite period. It talks about periodicity. And then cost. Recording asset at a historical cost and not the market value. And then dual aspect, it talks about every transaction has two effects. Okay, duality. And then revenue recognition, record revenue when earned on realization. Yes. Then we saw matching concept, matching expenses with related revenues. Okay, that's called accrual. And then full disclosure, disclose all material information. Okay, you have to, so that there is enough transparency in the business. Then consistency, use same methods over period. That's what it's talking. Why? To ensure uniformity. Then conservatism, anticipate losses and not profits. That is prudence. Materiality, focus on significant facts only. So what are the significant facts? Only that has to be recorded. It talks about significance. Then objectivity, record based on verifiable evidence. Okay, so you should have the supporting documents to check your transaction. So verifiability. So with this we've come to the end of this video. So if you have any doubts, please let me know in the comment section. We'll continue this in the next video. There's one more part. The same video is also available with Tamil explanation. Link will be provided in the description. See you in the next video. Until then, bye.